In this week's video, we'll be talking about imposed regulation versus self-regulation, and we'll be giving some examples of imposed and self-regulation. In the chapter reading, they talk about capitalism and socialism. The chapter does a very good job of going over a lot of the nuances of capitalism, and just focus on the following things. Capitalism means that production and distribution is in private hands, right? So we can say private hands meaning not the government. Socialism means that production and distribution are in public hands. So when you think of the public, just think of government. Now, of course, there's a lot more detail involved in this, but for the purposes of our class, what I want you to know is that capitalism is not the government, so it's private individuals, whereas socialism typically involves the government to a larger extent. The chapter talks about the different elements of capitalism. So the chapter mentions that the elements of capitalism include 4 different things. So in order to have capitalism, we need to have companies, right? And the purpose of a company is to manage risk. So that means that if I'm going to form a company, then I might have 5 different shareholders. If I have a company and 5 different shareholders, then the risk for loss is going to be split amongst 5 different peoples. Also, when you manage risk, you're also able to pool more resources. So if I have 10 different investors in a business, then I can get money from each of the 10 different investors, and that might be more money than I would be able to generate just on my own. Companies also exist for profit motivation. So companies try to generate a profit, and of course profit is simply revenue minus your expenses. The next element of capitalism is this notion of competition. So this is actually one of the most beneficial elements of capitalism, is this notion that I can decide to produce a cell phone. And then if I'm profitable, then other companies are going to try to develop a similar product. So that's good for the consumer, because if we compete against one another, then it enhances innovation. And finally, capitalism involves personal property. So if you generate a profit, you can keep the profit, and you have the right to own personal property or assets. The chapter also talks about the different stages of capitalism. And what you need to know here is that capitalism started out as a mercantile or bartering system, and then it evolved into more complex forms. The chapter also talks about the theoretical basis of capitalism and the operational basis of capitalism. So the chapter talks about how capitalism in theory might not make sense because it encourages wealth and might promote poverty. So in theory, capitalism might work, not work, and also operationally, it might not work as well. So if you walk down a street, maybe in a big city in the United States, you might see homeless people, and then you might see Jeff Bezos, who during the coronavirus became even wealthier than he was before, and other people might have lost their jobs during the coronavirus and become homeless. So the operational criticism of capitalism, there's a lot of different things mentioned in the chapter, but what you should know is that it promotes inequality. Okay, so that's a little bit of theory. The chapter does a good job of going over a lot of theory, but the theory is important because of this. This is the most important thing you need to know in the chapter. The most important thing you need to know is that capitalism means not the government. Okay, so this means capitalism is the foundational basis for this notion of self-regulation. Self-regulation. Self-regulation means that industries create their own rules. What is the basis for imposed regulation? Imposed regulation comes from this idea of socialism. Okay? Socialism is government control. Imposed regulation is the notion that rules are imposed by typically the government. Okay, so let's think of some examples here. Okay, so self-regulation, that means that an industry can create their own rules. They can govern and police and manage their own practitioners. If you look at the Chapter 3 notes, here, this is an example of self-regulation. Okay, so this is called the Motion Picture Association of America Movie Rating Guide. Okay, so here we have an example of self-regulation. And what happened was that the Motion Picture Association of America, they started to realize that parents were taking children to movies that they weren't comfortable with because they thought it was inappropriate for children. The motion picture industry realized that people wanted to have some type of way to know what to expect from a movie. Is the movie going to have a lot of profanity in it? If so, maybe I don't want to take my young children. Is the movie going to have a lot of violence in it? If so, maybe I might not want to take my 10-year-old nephew. So the Motion Picture Association of America actually came up with these set of standards, and they did this independent of the government. They decided that they needed to police themselves, and so they created this movie rating guide. So you have rated G, which is for general audiences, all the way up to NC-17. So no one under 17 is admitted. Okay, I think NC-17, sometimes that was called rated X at one point. But this is an example of self-regulation. This is where industries create rules to govern members of their industry. And in this example, the motion picture industry created rules to govern their industry. If you look at Exhibit B, this is an example of imposed regulation. Okay, so we're going to talk more about Sarbanes-Oxley a little bit later this session, but for the PCAOB, what you need to know is that the PCAOB was essentially started by the government. It's the Public Company Accounting Oversight Board, and the PCAOB certifies auditors of public companies. So that means if you want to audit a public company, then you have to be certified by the PCAOB. And the PCAOB is going to create different rules that you have to follow. And who created the PCAOB? It was essentially the government, Congress. So this is an example of imposed regulation. The PCAOB is stepping in and it's telling the accounting industry what rules to have, what requirements to follow. So this is called imposed regulation. Okay, so let's go back up here, and I want to give you some more examples of imposed versus self-regulation. Imposed and self-regulation is the key concept in this chapter. Corporate governance. Corporate governance is an example of self-regulation. So let's look at corporate governance, and I'll read you what it says here. It says corporate governance is a set of relationships between a company's management, its board, its shareholders, and other shareholders or stakeholders. Corporate governance provides the structure through which the objectives of the organization are set. and the means of monitoring and achieving those objectives that are defined. So the purpose of corporate governance is to set up the structure of a company and develop rules and procedures. Now, who creates corporate governance structures? It's created by the company itself. So we can say that corporate governance is an example of self-regulation. Now, within corporate governance, there's this notion of levers of control. This is from Robert Simons of the Harvard Business School. Let's take a look at the levers of control. So this is another way to think about corporate governance. So according to Robert Simons, corporate governance is composed of 4 different systems, and you have internal control here at the middle here. Internal control ensures that everything is accurate. Okay, so internal control is making sure that data is accurate. There is no financial misstatements that are taking place. And according to Robert Simons, corporate governance consists of 4 different things. Let's look at each of these different things. The first is called the belief system. So belief system is basically the mission statement of an organization. Belief system is telling employees what they should be doing, so should do. Maybe our mission statement will be to provide outstanding customer service and innovative products in the field of accounting. That could be a belief system. On the other side here, we have boundary control system. Boundary control system tells employees what they should not do. Okay, so you can see here risks to be avoided. So an example of a boundary control system would be a code of conduct. Don't do something. Also, we have interactive control systems. And notice here it says strategic uncertainties. So interactive control system is where you're looking out for the future. So it's future or forward-looking. So do we have research and development? What are we doing to prepare for the future? What are some threats that we've identified in our industry? What are some opportunities? That's interactive control system. You can think of diagnostic control system as being about the past. You can look at financial statements. Financial statements are about what happened last quarter or last year. That's an example of a diagnostic control system. Okay, so you can see that according to Robert Simons, corporate governance involves core values or a mission statement. What do we stand for? What is our company charged with doing? What should the company avoid doing? That's called boundary control system. How are we looking out for the future in terms of threats and opportunities? That's interactive control. How are we evaluating what happened in the past? We can look at our financial statements. We can create an income statement. That's called a diagnostic control system. When you look at the notes, you can see also in Exhibit C, we have another depiction of corporate governance. Let's take a look at this here, Exhibit C. So for corporate governance, this is another depiction of the different structures that you can have, or the different players you can have in the corporate governance system. What I want to point out is that you have the board of directors, that's here, and the board of directors interact with the shareholders, and the board of directors are also in charge of overseeing management. Okay, so you can see here board of directors overseeing management. Now, the board of directors have 3 committees. So if you look at a corporate governance system in the United States, there are 3 different committees. There's a governance committee, compensation committee, and separate is the audit committee. Okay. So the governance committee essentially establishes rules and procedures. It creates an organizational chart for the company. That's corporate governance, or the governance committee. Believe it or not, there's also a separate compensation committee. So the compensation committee is in charge of figuring out what the starting salaries are going to be for certain types of employees. They're going to establish the bonus system for the company. They're going to evaluate the performance of different individuals and figure out whether they should get a raise or whether they should get a bonus. And so there's an actual separate committee that's charged with only dealing with compensation. Look at what you have here. It's the audit committee. Okay, so every company needs to have another set of accountants come through and then re-examine the books to make sure everything looks good. So you hire auditors to certify the books. Okay, so auditors can be on the outside, external auditors, or you can have internal auditors. But notice here that the auditors deal directly with the audit committee, but they don't deal with, this is a broken line here, they don't deal with management. Okay, they might talk to management to some extent, but they don't report to management. The auditors report to the audit committee. And the audit committee oversees what? It's the whistleblower program within the organization. So if you decide to complain about your boss and you're not comfortable going to the boss directly or even your boss's boss, then you can go and escalate and report to the audit committee. So what you need to know here is that corporate governance involves different committees and different structures. Now, this structure here is not going to be true for every single company, but this is a basic depiction of what exists in pretty much all companies within the United States. Here, we have another figure, and you can see that we have these different players. We have the board of directors, lawyers, auditors, stakeholders. But look at this down here. Corporate culture. Remember, we talked about corporate culture, and corporate culture can be either explicit or implicit. So corporate culture can involve rules that are explicit, meaning they're written down, or corporate culture can be implicit. There could be rules that are not written down, but are expected to be followed anyways. For example, if everybody goes to a restaurant after work, maybe that's not a written down rule, but it's understood that you should be doing that if you can. So for this figure here, I'll let you just look at this yourself and know that there are different structures for the corporate governance system. And also, corporate governance typically conforms to this lever of control notion. Let me give you another example of imposed regulation. Okay, so the example that I gave before was the PCAOB, but now I'm going to give you another example of imposed regulation. But first, what does imposed regulation mean? What would you say? It's where the government steps in and creates rules for people to follow. So if you look at liability, liability is actually a form of imposed regulation. Let's take a look here. If you took business law, you've probably learned of the notion of negligence, gross negligence, and fraud. That's an example of imposed regulation. The government is stepping in and saying, we're going to define what negligence means. And if you're negligent, then you're going to be subject to a certain penalty. That's not an example of a company creating rules for itself. It's an example of the government stepping in and creating rules for the industry or company to follow. Right? They don't have a choice. What are the elements of negligence? Well, you can see the letters that I wrote here, D, B, D, C. So negligence involves duty to care, breach of duty, damages, and causality. So for an example, let's say that I'm a doctor and somebody comes in and complains that they can't breathe, right? So I have a duty to care because I'm a physician and a patient is coming to see me. Well, what if I don't listen to their heart or don't listen to their lungs, right? They say they can't breathe and I'm not listening to their lungs. Well, I should have listened to their lungs, so that's a breach of duty. What if this person ends up with pneumonia? Well, that's damages. Something bad happened. And why did they get pneumonia? Well, they got pneumonia because the cause of it was my failure to do something. So that's negligence. Okay, so you can think negligence means you have a job to do, a duty to care. You don't do your job. Somebody gets hurt. And the reason why they get hurt is because you didn't do your job. That's called negligence. Now, some states also have this notion of what's called gross negligence. It's Mr. Rid. So for those people taking the CPA exam, this is something that you'll need to know. So gross negligence means that you have a material misrepresentation, you have reliance, reckless disregard for the truth, intent to rely, damages. Okay, so let me give you an example to help you understand what gross negligence means. Let's say that I'm going to sell my house. My house is only worth $100,000, but I'm going to sell it to you for $1 million because I'm telling you that there is oil underneath my property. There really isn't. That's a material misrepresentation. It's basically a lie. So you believe me, so you rely on my statement. By the way, I don't know whether there's oil under my house or not. I mean, I never checked. Probably I should have checked, but I decided I didn't want to check. I'm probably lying, but maybe there's oil, maybe there's not, probably not, but I have a disregard for the truth. Now, you believed me, you relied on my material misrepresentation, and you followed through. You actually not only believed me, but intent to rely means that you followed through and you actually paid $1 million for my property. So when you do that, you actually overpaid, you were ripped off, and you incurred damages. This is gross negligence. Okay, so gross negligence, the most important component is this reckless disregard for the truth. So as an accountant, if you tell a client something, they believe you, and then they follow through and actually take some type of action based on your statement, which is not correct. And you don't even know if the statement is not correct or incorrect. You just really don't have any idea, but you never really bothered to discover whether you're right or not. We call that gross negligence. Fraud is the worst form of liability. And this is an example, of course, of imposed regulation, like we said. Let's talk about the elements of fraud. It's Ms. Rid. Fraud involves material misrepresentation. That means saying something that's not true. Scienter. Scienter is a lie. Reliance. Intent to rely. And damages. Fraud is extremely important to know. We'll be going over some case studies that involve fraud. So fraud means that I tell you something that is not true. So I say, oh, I'm going to sell my house. The house, according to Zillow, is only worth 100,000, but I'm going to charge you $1 million because I'm telling you there is oil under the house. Um, I've actually paid somebody to come survey the land, and there's 1 million barrels of oil under the land, and I know there isn't. Okay, that's just a straight up lie. It's not a question of, oh, I'm not sure. It's a question of, I know there isn't, but I'm telling you there is because I'm lying to you. You actually believe me. You actually believe the statement that I told you, and then you intend to rely on my statement. You say, okay, well, I believe that there is oil under this property. I'm going to go ahead and pay $1 million for it. And as it turns out, there's no oil. So you suffer damages. Okay, so what you need to know is that when it comes to liability for accountants, the basic forms of liability are negligence, that's bad, but in the middle is gross negligence, that's worse, and worst of all is fraud. Okay, so this is from bad, worse, the worst. Okay, so just to recap real quick here, the chapter talks about the theory behind socialism and capitalism. We know capitalism means it's not the government, it's private individuals. Capitalism is the reason or basis behind this notion of what we call self-regulation, this notion of industries wanting to create their own rules. Socialism is more about control being in public hands, or public typically means the government. Socialism is the basis for imposed regulation. So we have self-regulation and imposed regulation. And my last question to you is, what do you think companies prefer? Do you think they would rather have self-regulation or imposed regulation, and why?